The dollar has weakened to levels last seen at the start of 2015, and the consequences of that are a soaring yen, a rampant euro, and stronger emerging market currencies. So, are these in line with long-term trends, and do they reflect the value in these currencies? Well, with me to discuss these issues is the CIO in currency management at JPMorgan Asset Management, Roger Hallam. Roger, first of all, why is the dollar so weak?
I think first of all, the US economy is unimpressive. It recorded a sub 1% growth rate last quarter. That has pushed the Fed on hold in terms of its policy normalization cycle, and that has resulted in the dollar trend reversing from what we've seen in the past couple of years.
So the value over a long period of time, as we'll see in our first chart of the dollar, reflects the fact that we should be now, we are actually at the end of a cycle, aren't we?
Yeah, the dollar has tended to trade in 6 to 10 year cycles, generating price movements of between 20 and 50%. And as you can see from the chart, the dollar based 5 to 6 years ago and has appreciated by 20%. So we think this cycle in the dollar so far has broadly fulfilled those historical characteristics and is near completion.
Now, our second chart is about the yen and about the value of the yen. And if we see the fact that here at the very end is, while we talk a great deal about the strength in the yen, over in the broader perspective is actually it's still pretty cheap.
Yeah, I mean, the yen is one of the strongest currencies year to date, but the chart shows that from a long-term PPP perspective, the yen remains one of the cheapest currencies and exhibits many of the characteristics of a cheap currency. The current account surplus is going to be something like 4 to 5% surplus this year. The trade balance is moving back into balance from what was a 2 to 3% deficit.
So a weak dollar is clearly a benefit to emerging market currencies after what was a pretty torrid 2015. You're seeing the tide turn, aren't you?
Yeah, we've seen flows out of emerging markets really for the last couple of years as commodity prices fell and sentiment with China was quite negative. However, we're seeing evidence that flow tide is turning. Yields in government bonds and investment-grade corporate bonds are very low. Emerging markets still offer some relatively favourable yields. So we're starting to see investors start to reach for emerging markets, also with some of the fundamentals being a little better given the bottom we're seeing in commodity prices and perhaps a more positive sentiment towards China.
Okay, so in conclusion, Roger, a weak dollar, still some value to be extracted out of the yen and the tide turning in emerging markets. Are we seeing the rest of 2016 pan out? Is this a favourable now opportunity for investors?
I think a lot will depend on US growth in the second half of this year. If it remains lackluster, we can expect to see the Fed remain on hold. If it picks up, then we could also see the Fed start to renormalize rates. So I think a lot will depend on the Fed outlook, but at the moment it looks like we're going to be in a softer dollar environment, certainly for the next few months.
Roger Hallam, thank you very much.